On the day before the Fed meets in Jackson Hole, and we find out whether there's any hints about future rate cuts or rates not cutting or whatever's going to happen tomorrow at Jackson Hole, we've got data. So if the Fed's looking for data, boy, they've got data today, and almost all of it points to a great economy chugging along at about 2.5% GDP increase. Yeah, there's not a lot negative in today's news, but the negative would be that the economy's doing great. Therefore, we won't get the cuts. And if we don't get the cuts, then the market might have to take a breather. Quite frankly, I'm going to continue with my theory that we might see a continuation to something like a 5% correction, maybe even a 10% correction here in August and September, and then Katie bar the door. Market Watch says what's this? The favorite stocks. Listen to this now. This is for Tesla. Tesla's down today, even with this news. Listen to this now. The favorite stocks of hedge funds have outperformed the broader market this year, and for the first time since 2022, Tesla is one of them, an analyst from Goldman Sachs found. The analyst, based on the 13F filings to the Securities and Exchange Commission, shows that what Goldman calls its hedge fund VIP list of stocks, which is available in an ETF wrapper GVIP, returned 15% versus the 11% for the S&P 500, and 7% for the equal weight version. The VIP lists are positions that appear most frequently among the top 10 holdings of hedge funds portfolios. It's a very tech heavy at the top, led by Amazon, followed by Microsoft, Meta, etc., Taiwan Semiconductor, all the regular characters, Capital One Financial, MasterCard. That said, every sector except real estate is currently represented on the list. Tesla, whose stock has sputtered amid deteriorating sales, ranks number 30 among all hedge fund holdings. Companies around the world are investing billions to win the self-driving race, according to this article, which I got from I forget where, and I didn't write it down. I always write it down. How did I forget to write this one down? Anyway, so this is a very good article. I'm very sad that I'm not going to be able to give credit right now. Anyway, from time to time, the payout is described as being worth trillions. Oh, I know, it's Forbes. It's Forbes. Yeah, this is another positive article from Forbes. How can that be? Okay, let me start over. Companies around the world are investing billions to win the self-driving race. From time to time, the payout is described as being worth trillions. Tesla's 1 trillion market cap is often attributed to hope that they will be dominant in this place. At the same time, others question if there's much of a business there at all, and I was one of the main original advocates for this Robotaxi vision. It's time to examine it again, but it's not about ride hail. Put most simply, the value proposition is to create a self-driving mobility on demand, is what he's going to call it, service which is good enough that a decent fraction of people decide they can partially or fully give up some or all car ownership. Today, the world spends about $5 trillion annually on ground transportation expenses, so it's entirely possible to see trillions of value for the companies that revolutionize that. A company that sells rides and shipping as a service is selling the entire value chain, not just the vehicle. This is not the only way to make money from self-driving, of course, and many other companies have different targets. In fact, today, all we see of the ride-hail companies is that they're like not like traditional taxis. They are like traditional taxis with higher priced rides on demand, which don't easily replace owning a vehicle. Uber brings in $44 billion a year, which is far from chicken feed, but a small fraction of the big picture. We also see companies trying to make self-driving cars to be owned by consumers, hoping to create the most must-have car feature and prosper in the vehicle market. Last week saw the launch of Tensor in that area, and Tesla hopes to make all their cars retroactively capable. Waymo and Toyota have also announced plans to build such cars. There are many other applications in delivery, industry, agriculture, mining, and more. You know what he doesn't even mention? Trucking. He says delivery, but you know, he's thinking that sounds like local delivery as opposed to trucking. Since today, the typical car owner spends $7,000 to $12,000 per year on car ownership, taking over that is highly lucrative, but harder to do with a taxi service that's much more costly per mile than an ownership. Most of the personal transportation industry today revolves. People love car ownership, and they spend outrageously on it. It's often the second largest personal expense after housing. It's not economical. Alternatives like transit can cost much less, at least when subsidized, but people will pay for the luxury of owning their own car. Only a fraction of the population, now listen to this carefully. Only a fraction of the population will be willing to replace car ownership for quite some time. It doesn't say what time that is. I'm thinking it's probably 5 years, 7 years. But it's much easier to convince people to give up third and second cars in a household, which we've already done. And some will give up all of them. New generations are generally more amenable to shifts like this. Only 1/3 of households have only one car right now. So second and third cars are right for car replacement at the right price. If you replace car ownership for somebody, you take over much more spending than just vehicle purchases. You become the replacement for the oil, electric companies, car loans from banks, dealerships, cleaning, parking, insurance, services, parts, tires, and more. All of these are large industries. You subcontract many of these things, but you are in charge. You own and bill the customer and control where the money flows, and you make sure the best part flows to you. Tesla has pioneered some of this. Tesla has some customers for whom they provide the car, the service, the charging or solar on the roof, the insurance, the service, and the financing. This is the point that Gary Black doesn't get. You need to offer a great service that almost fully replaces the private car. That means that urban robotaxi is just the start. You must also please the customers going on ski trips and other road trips, towing boats to the lake, taking kids to soccer, and every other reason people own a car. That's pretty hard. So you won't get everybody, and you'll have to offer sweeteners like lower costs and lower hassles to make up for what you can't deliver. Fortunately, you can offer things like not having to drive or park, not needing a garage, no ownership hassles, access to every different kind of vehicle on demand, and several other factors. You also have to provide great mobility on demand. One's personal car is always there. There's never a wait time. So, but it could be parked further away. That's a problem. Where do you park it when you get to the other end? There's never a surge. There's never a surge in what you pay for your car. You pay for that exclusive access, but people today are willing to pay. And there's no really great replacement for the ability to keep your stuff in your private car and have it always there with you. No, there's a go bag. I believe in this go bag concept. Maybe you'll have 2 or 3 go bags at home with different setups in them. There must also be a solution for everywhere that robotaxis won't go, such as human-driven services. A robotaxi that takes you on a seamless transfer to a U-Drive rental car or a car delivery service that brings a car for those trips out of town. No, robotaxis, cybercabs will go everywhere. Everywhere. No, he's missing the point here. This guy's so clever. Everything, so much of what he says is so good. But no, cybercabs will go everywhere. As tough as great mobility services are, in many cities of the world, many people give up car ownership. Even the American city of New York. It's much harder to obtain that in places like suburbs where car ownership is made very easy, thanks to garages in every house and free parking in every business. Even though people may not be thrilled with what they did to urban design, it would take many decades to reverse. To win the battle of mobility services versus personal robocar ownership, the main tool a service can have is price. Of course, a company can and will be a player in both the car replacement and car businesses. That's Tesla. These leave the following core markets for self-driving technology in the rough order of market size: car replacement, Could be by subscription, which we've recommended on this channel. Features on features on consumers' cars. You can get luxury cars. You'd be able to rent a luxury car instead of just a regular car. Shipping, of course, can be taken care of. Specialty vehicles like transit, ride hail. And then you have off-road. That'll be a little harder. Campus, agricultural industry, mining, and airports. So very different kinds of vehicles for those. The all-in cost of car ownership today is estimated to be around 60 cents a mile plus parking. I don't know why he adds parking, though it can be much less if the car is old, more if new and expensive. $2 to $3 per mile ride-hail services can't compete with the robocar owners if they want to get rid of their car. Worse, many car owners act like their car only costs the incremental cost of operating it, which can appear to be under 5 cents a mile on an EV. That's an illusion, but it's how people do think. The cost of goods sold for a low-cost robotaxi can get very low, perhaps under 20 cents a mile, which people are arguing with Elon in this. I've done the numbers over and over again. I think it's going to be hard to get under 25, but I think it's possible. If the Cybercab costs less than $16,000 to Tesla, it might be under 20 cents. It won't get there for some time unless R&D costs reduce and things happen at large scale, which is what Tesla's going to do, even though it will require new creative pricing models to compete with how people perceive the cost of a private car. It's not going to be 20 cents to the consumer. It's going to be 20 cents to Tesla. Elon has mentioned they might get as low as 30 cents cost to the consumer. I think that's too low. I think 50 cents is probably the bottom. Flat rate pricing, at least for some aspects of the car, will be a must. In addition to low cost, the new markets will rely on one key difference between robots and humans. Robots don't mind waiting, nor do they mind working 24/7. These are things robots will do that human drivers never would. And this will open up and make economical new classes of services. People have had chauffeurs and taxis since before there were cars. The new revenue opportunities come from services that were not possible before. Until then, the robocar industry will be limited to the small car markets of ride-hail and luxury car add-ons and subscriptions. Car replacement may succeed or fail in different markets, though if it fails, there's still plenty of money to make, just not in the trillions. No, people will switch. People will get rid of their cars. You can start with old people, people that have some kind of disability, people that just hate to drive. I know so many people that will not drive on the freeways. Just go on down the list. Okay, Benzinga then takes the opposite side. They say prominent short seller Jim Chanos challenged Tesla. Elon Musk's ambitious robotaxi cost projections on Wednesday, calling the sub 20 cent per mile assumption absurd. Chanos wrote on X, this is a big robotaxi assumption, namely that at scale, cost per mile will be below 20 cents. That is absurd. ARK analyst defends. He says the criticism came in response to ARK Invest analyst Daniel McGuire's bullish robotaxi analysis. McGuire argued that Tesla could meet Austin's entire urban vehicle miles traveled demand with only 200,000 vehicles, leveraging the company's data advantages, vertical integration, manufacturing, and cost per mile advantages. Sorry, Gary, keep mentioning your name. Maybe you like it, but Gary Black doesn't think this is true, but I do, and so does ARK. Thanks to data advantage, vertically integrated manufacturing, cost per mile, we think Tesla can undercut Uber's pricing umbrella and scale rapidly to dominate the US and potentially globally, McGuire wrote, projecting Tesla's robotaxi business would represent 90% of its enterprise value by 2029, except that ARK still doesn't put Optimus in there, so it's going to drop to like 30%, and Optimus will be 70%. The dispute centers on projections from Tesla's October 2024 We Robot event where Musk unveiled the Cybercab robotaxi. He predicted 20 cents per mile operating costs and production starting in 2026, both of which are going to happen. So we'll see what happens with all of that. I know this is a very long show today, but man, it gets more and more interesting. Wait till you'll hear the second half when we get into the economics now. If you like the economics and if you want to really know what's happening with the economy and what might happen with the macro and why the S&P is up, acting the way it is right now, we're going to get into that next. If you like what you've heard already, or even if you don't, just push like. Hit subscribe, hit notify. Yes, normal day. No, not normal day. Today we got Nicholas Gibbs because they switched. He switched with Brad Ferguson, and then we've got Cern Basher later tonight. That is the regular program. All right. The S&P is only down 1.5 so far. It's only down 1.5, okay? My thinking is maybe in August and September, because August and September supposed to be nasty months, the worst months of the year, etc. Will that theory hold? We'll get the 5%, maybe even a 10% pullback, and that will be an amazing setup. You just need that kind of breather, pull it back a little bit, and then we can be off to the races, maybe for a 15% to 20% overall increase for the year. Walmart this morning said they joined with basically Home Depot and Target. All three of these companies are saying that the consumer is resilient. There is no evidence of reduced activity. According to Home Depot, they said only problem was on the durables. But Walmart, they're saying, hey, we're up, we're up, same store. Comparisons, 4.3, something like that, bigger than what was expected by the street. Tariffs are being handled case by case, according to all three of them, and only slight increases are coming through. Walmart, only 1/3 of their product is purchased overseas. 2/3 is U.S. I didn't know that, according to their call this morning. Higher priced items need help from the Fed right now. This is what we need right now. This is Home Depot saying we need the Fed to lower costs so that these durable items can get picked up again. As we've kicked illegal aliens out of our country, J.D. Vance says, you actually see housing costs starting to level off. Oh, really, J.D.? Well, I've been saying that for how long? For months and months and months. Thank you for agreeing with me. Global Market Observer says U.S. freight shipments are sliding fast. The CASE Freight Index, a key measure of freight volumes in the U.S., has fallen to its lowest level since 2020. This signals weakening demand for shipping and goods movement and a slower economy. Okay, but here's the thing. Truck tonnage is impacted by many things. But durables and housing are the remaining parts of the economy that are suffering, and both of them use lots and lots and lots of trucking. And so if we want to get this done, we need the Fed to lower interest rates by 50 to 100 basis points, and that will help durables, and then it will probably result in mortgages getting down to around 6% or maybe even into the 5s. This is what we need. And the Fed, anyway. In the week ending, this is initial jobless claims. In the week ending August 16th, the advanced figure for seasonally adjusted initial claims was 235,000. Now you go, oh, well, that's 11,000 more than last week. It's been running around 222, but it was 241 a few weeks ago, and they might revise this downward. But anyway, 235, it's a little higher number, but listen to this. The 4-week moving average was 226. That was an increase too. But the advanced seasonally adjusted insured unemployment rate is still 1.3%. And the total number of continued weeks claimed for benefits in all programs for the week ending August 2nd was 2 million, basically 2 million, a decrease of 26,000. So people are getting their jobs. If they're getting laid off or they're quitting, whatever they're doing, and they're getting a new job quickly. Manufacturing activity in the region. This will be the Philadelphia Fed. Manufacturing activity in the region weakened this month, according to firms responding to August Manufacturing Business Outlook Survey. Current general activity index fell to near zero. New orders index dipped into negative territory, and the shipments index also declined, but remained positive. The employment index continued to suggest overall increases. Both price index remained elevated. The firms continue to expect growth over the next 6 months, and expectations were somewhat more widespread of growth over the next 6 months. The price index, the input price, so the prices paid and the prices charged index both were up. The current prices received index ticked up only 1 point to 36.1, whatever that means. It doesn't really mean anything. All right, so there's the Philadelphia Fed. Hey, things right this minute, not quite as good, but future looking great. Then we have this breaking news. U.S. business activity grew at the fastest rate recorded so far this year in August, according to the flash PMI data. This adding to signs of a strong third quarter. Growth was seen across both manufacturing and service sectors. This is the overall country. Hiring also picked up. Job creation reached one of the highest rates seen over the past 3 years, as companies reported the largest buildup in uncompleted work since May of 2022. Business confidence improved, but remains much weaker than seen at the beginning of the year, of course, when people are all going crazy over Trump being elected. And tariffs were widely cited as a principal cause of sharply higher costs, which in turn fed through to the steepest rise in average selling prices recorded over the past 3 years. But remember, these are prices, not inflation. And that's according to Fed Chairman Powell, among others. Chris Williamson, chief business economist at S&P Global Market Intelligence, says a strong flash PMI reading for August adds to signs that U.S. businesses have enjoyed a strong third quarter so far. The data is consistent with the economy expanded at the 2.5 annualized rate, up from the average 1.3 expansion seen over the first 2 quarters of the year. Companies across both manufacturing and services are reporting stronger demand conditions. They're struggling to meet sales growth, causing backlogs of work to rise at a pace not seen since the pandemic-related capacity constraints of 2022. Stock building of finished goods has also risen at a survey record pace, linked in part to worries over future supply constrictions. While this upturn in demand has fueled a surge in hiring, it has also bolstered firms' pricing power. Companies have consequently passed tariff-related cost increases through to consumers in increasing numbers, indicating that inflation pressures are now at their highest for 3 years, except that isn't inflation. It's price. The resulting rise in selling prices for goods and services suggests that consumer price inflation will rise further above the Fed's 2% target in the coming months. Indeed, combined with the upturn in business activity and hiring, the rise in prices signaled by the survey puts that PMI data more into rate hiking rather than cutting territory, according to historical relationships between these economic indicators and the FOMC policy changes, at least under Powell. The S&P Global U.S. Manufacturing PMI rose from 49.8 to 53.3 in August, according to the flash reading, signaling a renewed improvement of factory business conditions after a deterioration in July. Also breaking, the Conference Board, nobody pays attention to the Conference Board, of leading economic indicators for the U.S. inched down by 0.1%. to 98.7 after declining by 0.3% in June. The LEI fell by 2.7% over the last 6 months, a faster rate of decline than its 1.0 contraction over the previous 6-month period. So what is leading indicators getting their information that's completely different for S&P getting their information? The leading economic index for the U.S. decreased slightly in July, according to 𝐄𝐦𝐚𝐲, Senior Manager of Business Cycle Indicators at the Conference Board. Pessimistic consumer expectations for business conditions. They're paying attention. See, they're looking at that survey. That's where they're getting this idea. And weak new orders from where? What are you hearing? Weak new orders. Philadelphia Fed is the only one talking that way. Meanwhile, stock prices remained a key positive. Support for the LEI. Initial claims for unemployment insurance were much lower in July than in June and were the second most positive component of the LEI. While the LEI's 6-month growth rate remains negative, it improved slightly in July, but not enough to avoid triggering the recession signal again. But not enough to avoid. Despite that, the Conference Board does not currently project a recession, though we do expect the economy to weaken in the second half. Apparently, not S&P doesn't think so, and the Atlanta Fed doesn't think so. We do expect the economy to weaken as the negative impacts from tariff become more visible. Overall, real GDP is expected to grow by 1.6% year over year in 2025, before slowing in 2026 to 1.3%. They will be so far wrong on this that they should probably close up shop and go home. That's my feeling. The Bureau of the Conference Board leading indicator folks need to get a new group, get a new group of people to come in and start making these estimates. This is also breaking. All this is breaking news. Existing home sales increased. Okay, now nobody expected this. Existing home sales increased by 2% in July. Month-over-month sales increased in the Northeast, the South, and the West, and fell in the Midwest. Year-over-year sales rose in the South, Northeast. What? Didn't it? How did they got that in there twice? According to NAR chief economist Lawrence Yun, the ever so slight improvement in housing affordability is because affordability is inching up because the prices are coming down and the mortgage rates are coming down. Not great, not huge, but they're coming down. They're the lowest they've been all year. Wage growth is now comfortably outpacing home price growth. This should be wage growth is now comfortably outpricing home price growth, and buyers have more choices. Wow. Okay, Truflation this morning, 2.09 overnight, 1.94 year over year. Trump is sitting at 49. He's moved up now 2 points over the course of the week. The GDP, of course, is still at 2.3. We won't get a new reading on that until next Wednesday, I think. Okay. And where are we in the rest of the numbers? Let's go here to the VIX is up this morning, 3.31, but that happened, and now it's coming back down again rapidly. So it's at 1621. That's still, a very bullish number, a positive number. The Dow was down a lot, has come back. I can't decide which way to go. It is down 0.35, NASDAQ down 0.21, S&P down 0.31, and Tesla is down 0.42. But it's been down a lot more, and all of them seem like they're maybe trying to get into the green. We have got the Magnificent Seven. The Magnificent Seven is Google is up, Microsoft is up, and the rest are all down, but mostly fractionally. Like NVIDIA is only down 0.02%. I mean, Amazon and Meta are both down over 1%. And then the Cathie Woods are all down also. Now, what's going on here is that the bond market is looking at all these signals and going, the Fed isn't going to cut. We're not going to hear any good news tomorrow. And so therefore, what do you think? The bonds are up 3 basis points, back up to 4.326. After we were under 4.3, we're now well above 4.3. And the reason is the numbers are too good. The economy is too strong. And so the Fed probably isn't going to cut because this Fed is not going to take the risk. They just aren't. I'm sorry. They're not. I think the cut is off the table. Yeah, I know. There's a lot more data to come between now. I think it's September 18th. But between now and when the Fed actually meets, we'll get another CPI. We'll get another PPI. We'll get the jobs data next. Actually, not next week, but 2 weeks from now. We'll have all kinds of data that might change the Fed's mind and cause them to cut. Or maybe they'll take my advice and say, it's okay. Cut and raise later. It's all right. So bonds are up. Oil up a little bit, 27 cents, still under $63, $62.98. Natural gas up almost 2% at $2.80, but that's still well under $3. Gold up $1.10. Call that unchanged, $33.89. Silver is up 0.95% this morning at 38.13, getting back. It's really been in this 38.50 range is kind of where it's been hanging out. Copper is down just a tad, $4.43, where it's kind of been also. The dollar is drifting, it says here, waiting for Jackson Hole. Bitcoin down 927, 113. That's kind of been its low end of its recent range, between like 112 and 124, I think was the high. And those are the numbers that you would care about this morning. As mentioned, later on today, you will have Nicholas Gibbs instead of Bradford Ferguson. You will have Cern Basher bringing all kinds of amazing things tonight. And last night, you want to go back, there was no late show last night because the show that I did with Brian Wong went late. And so if you want to watch that one, which was, as always, chock full of incredible stuff from Brian, if you didn't see it already, you go back. It's still totally green. It's 100% worthwhile. I'll put that card right here. I know, very, very long this morning, but there was just so much good stuff for you today. It's been great talking to you.